On March 3, 2020, a small committee of unelected officials met, mostly by phone, and decided to cut interest rates by 0.5 percentage point, an emergency response to the earliest economic shockwaves of the pandemic. Within minutes, stock markets around the world moved. Mortgage rates shifted. Currency traders in Tokyo, London, and Singapore repriced trillions of dollars in assets before most people had even seen the headline. No one voted these officials into office. No president or prime minister approved the decision in advance. And yet their choice rippled through the global economy faster and more forcefully than most laws passed by any parliament that year. This is the Federal Reserve, and versions of this same story play out at central banks in nearly every country on Earth. You've probably heard the term. You may even know roughly what a central bank does, sets interest rates, prints money, something like that. But the actual scope of power these institutions hold and the genuinely strange position they occupy, simultaneously part of government and deliberately insulated from it, is stranger and more consequential than most people realize. Here is the mystery worth sitting with. Why do modern democracies deliberately hand control over something as fundamental as the money supply to institutions explicitly designed to be unaccountable to voters? Is that arrangement a carefully engineered safeguard against political recklessness? Or is it a quiet transfer of enormous power away from democratic accountability and toward a small group of technocrats and, some critics argue, the banking interests they were originally created to serve? To understand this, you need to go back to a genuinely chaotic period in monetary history. Before central banks existed in their modern form, individual commercial banks in many countries issued their own currency, backed by whatever reserves they happened to hold. This system was, to put it mildly, unstable. Bank runs, panics, and currency crises were common because there was no institution with the authority or resources to step in as a lender of last resort when a banking panic threatened to cascade through the entire financial system. The Bank of England, founded in 1694, is often cited as the first true central bank, though it operated quite differently from modern central banks for its first 2 centuries, initially created primarily to help the British government finance a war against France. The United States took a notably different and more contentious path. Early attempts to establish a national bank, first under Alexander Hamilton in 1791 and again in 1816, were fiercely opposed by figures like Thomas Jefferson and Andrew Jackson, who saw centralized financial power as a dangerous concentration of authority that threatened both democratic governance and the interests of ordinary farmers and small businesses against wealthy financial elites. Jackson successfully killed the Second Bank of the United States in the 1830s, and the country operated without any central bank at all for nearly 80 years, a period marked by recurring financial panics, including a particularly severe one in 1907 that nearly collapsed the entire American banking system, and was only stabilized through the emergency intervention of private banker J.P. Morgan, personally coordinating a rescue, since no official institution existed to do so. That crisis convinced Congress that leaving the country's financial stability dependent on the goodwill of a single private banker was untenable. And in 1913, the Federal Reserve Act created America's modern central bank. Crucially, and this detail matters enormously for understanding the debates that followed, the Federal Reserve was designed as a hybrid, a network of regional Federal Reserve banks, technically owned by private member banks, overseen by a board of governors appointed by the president and confirmed by the Senate, with a mandate to operate independently of day-to-day political pressure once those governors are confirmed. Why design it this way, deliberately independent from elected officials? The core argument, one that has been repeated by economists across the political spectrum for decades, centers on a problem called time inconsistency. Elected politicians face strong incentives to keep interest rates low and stimulate the economy right before elections, even if doing so risks longer-term inflation, because the political benefits of a booming economy arrive quickly, while the costs of inflation often arrive later, after the next election has already happened. A central bank insulated from these short-term political pressures can, in theory, make decisions based on longer-term economic stability rather than electoral timing, raising interest rates to cool inflation even when that's deeply unpopular in the moment. This theory has real empirical support behind it. Economists have found a consistent historical pattern. Countries with more independent central banks have generally experienced lower and more stable inflation over time compared to countries where political leaders retain direct control over monetary policy. Argentina and Zimbabwe, both countries that experienced periods of direct political control over their currency printing, suffered catastrophic hyperinflation as a direct result. Cautionary examples central bankers frequently point to when defending the case for independence. But independence from day-to-day political pressure is not the same as independence from power or consequence, and this is where the criticism sharpens considerably. Consider what a central bank's main tool, the interest rate, actually does when it moves. Raising rates makes borrowing more expensive, which cools spending and investment, which is precisely the mechanism used to fight inflation. But that same tool works by deliberately slowing the economy, which means job losses, business closures, and financial pain concentrated disproportionately among lower-income workers who are typically first to lose employment during an economic slowdown, while wealthier asset holders, who own stocks, bonds, and real estate that a central bank's policies also directly affect, often experience the pain quite differently. This tension became impossible to ignore during the response to the 2008 financial crisis. Central banks around the world, led by the Federal Reserve, deployed a previously unconventional tool called quantitative easing, essentially creating new money to purchase government bonds and other financial assets at massive scale in an effort to keep credit flowing and prevent a full economic collapse. It worked in the narrow sense that it likely prevented a much deeper depression. But it also had a side effect that became a central point of criticism. By pushing money into financial markets, quantitative easing significantly inflated the value of stocks, bonds, and real estate, assets disproportionately owned by wealthier households, while wage growth for ordinary workers remained comparatively sluggish for years afterward. Economists still debate exactly how much quantitative easing contributed to rising wealth inequality in the decade that followed. But the optics, a policy explicitly designed to rescue the financial system disproportionately benefiting people who already owned financial assets, became a lasting source of public distrust. Why does a central bank have this much reach into decisions that feel on their face deeply political? Who bears the cost of fighting inflation? How much wealth inequality is an acceptable side effect of financial stabilization? Central banks typically justify their broad mandate through a specific legal structure, a dual or sometimes single mandate set by legislation, usually something like maintaining price stability and, in the case of the Federal Reserve specifically, also promoting maximum employment. But within that broad legislative mandate, central bankers retain enormous discretion over exactly how to pursue those goals, discretion that functions, in practice, as a form of policy-making power that in most other areas of government would run through elected legislators, not appointed technocrats serving long, deliberately insulated terms. It's worth being fair to the other side of this specific argument, too. The Federal Reserve is not entirely unaccountable, even if it is deliberately insulated from short-term political pressure. The Fed chair testifies before Congress multiple times per year, subject to direct questioning from elected representatives. The Board of Governors appointments require Senate confirmation, giving elected officials real, if periodic, influence over who holds these positions. And the Federal Reserve Act itself can be amended by Congress at any time, meaning the institution's independence exists entirely at the pleasure of the legislature that created it, a check that, while rarely exercised in practice, remains a meaningful structural limit that distinguishes central bank independence from genuine, permanent unaccountability. This is where a structural criticism becomes harder to dismiss than complaints about any single policy decision, the relationship between central banks and the commercial banking sector they regulate and, in crises, rescue. Critics, including some economists who otherwise support the general case for central bank independence, point out that central banks were originally created partly in response to banking crises, and their emergency tools are frequently deployed to rescue the very financial institutions whose risk-taking helped cause those crises in the first place, a pattern sometimes described as privatizing profits while socializing losses. During the 2008 crisis specifically, the Federal Reserve extended trillions of dollars in emergency lending to major banks, several of which had engaged in the risky lending and trading practices that triggered the crisis. While ordinary homeowners facing foreclosure received comparatively far less direct assistance, a disparity that fueled the Occupy Wall Street movement and lasting public anger that persists in various forms today. Defenders of central bank crisis intervention argue this framing misses something important. Letting major financial institutions collapse during a genuine systemic crisis doesn't just punish reckless bankers, it can trigger a cascading credit freeze that devastates ordinary businesses and workers who had nothing to do with the original risk-taking. Since modern economies depend on functioning banks to process payroll, extend business loans, and keep commerce moving. From this view, rescuing banks during a genuine systemic crisis isn't really about protecting bankers specifically. It's about preventing a much broader collapse that would ultimately hurt ordinary people more severely than the rescue itself. Nowhere is the tension between central bank independence and democratic accountability more visible than in the Eurozone, where the European Central Bank sets monetary policy for 19 different countries that share a currency but retain separate governments, separate fiscal policies, and separate electorates who never voted for a single shared central bank governing all of them simultaneously. During the European debt crisis that hit Greece, Portugal, and several other member states starting in 2010, a topic this channel has covered in depth elsewhere, the ECB's monetary policy decisions, set primarily with the broader Eurozone's overall inflation picture in mind, often sat awkwardly against the specific, more severe economic pain individual struggling member states were experiencing, since a single interest rate cannot simultaneously be correct for Germany's relatively strong economy and Greece's collapsing one. Critics have long argued this structural mismatch, one monetary policy imposed across wildly different national economic conditions, represents an even starker version of the accountability gap than exists within any single country's central bank, since Eurozone citizens in struggling member states have essentially no meaningful electoral path to influence a shared institution controlling their currency, interest rates, and during crises, whether their own government's bonds get purchased or abandoned by the ECB's crisis intervention programs. The debate over central bank power has taken on new dimensions in recent years as central banks have expanded their toolkit and reached considerably beyond simple interest rate adjustments. The European Central Bank has, at various points, purchased corporate bonds directly, effectively picking which private companies receive cheaper financing. Central banks in several countries have begun exploring central bank digital currencies, a topic this channel has touched on in the context of dollar dominance, which would give these institutions unprecedented, direct visibility into individual financial transactions if fully implemented, a level of granular economic surveillance capability no central bank has historically possessed. So who benefits from the current arrangement and who bears the risk? Financial stability itself is a genuine, widely shared public good. Fewer catastrophic bank runs, generally lower and more predictable inflation than in eras of direct political control over currency, and a lender of last resort that can prevent isolated banking problems from cascading into broader economic collapse. Benefits that accrue, at least in theory, to essentially everyone participating in a modern economy, regardless of income or wealth. Commercial banks and, more broadly, owners of financial assets benefit disproportionately during crisis interventions and from policies like quantitative easing that inflate asset values, simply because owning more assets means capturing more of the upside when asset prices rise. Ordinary workers benefit from the employment stability that comes with avoiding severe recessions. but bear a disproportionate share of the pain when central banks raise rates to fight inflation. Since job losses concentrate heavily among lower-wage workers during the deliberate economic slowdowns, rate hikes are designed to produce and have historically received comparatively less direct benefit from the emergency tools deployed to rescue the financial system during crises. This is, in the end, another version of the efficiency versus resilience trade-off that runs through nearly every hidden system this channel has examined, though here it takes the specific form of independence versus accountability. Insulating monetary policy from short-term political pressure has genuinely delivered more stable, predictable inflation than the alternative history of directly politically controlled currencies suggests we would otherwise have. But that same insulation means some of the most consequential economic decisions any government makes, decisions with real winners and real losers, get made by officials voters cannot directly remove, justified by a technical mandate that, in practice, leaves enormous room for judgment calls that inevitably favor some groups over others. Which brings the story back to that quiet committee meeting on March 3, 2020, moving markets worth trillions of dollars with a single vote nobody outside a small room had any direct say in. Central banks occupy a position genuinely unlike almost anything else in modern governance. Powerful enough to reshape the material conditions of hundreds of millions of people with a single decision, insulated enough from direct democratic accountability that most citizens couldn't name a single sitting member of their own country's central bank board if asked, and yet still, formally, creatures of the very legislatures that could theoretically rein them in, but rarely do. Whether that arrangement represents hard-won wisdom about the dangers of short-term political control over money, or a quiet, largely unexamined transfer of extraordinary power away from democratic accountability, remains, like so much about the hidden machinery this channel keeps returning to, a question people looking at the exact same evidence continue to answer very differently.